Hello, today we're going to be talking about asset location versus asset allocation. There is a difference. Asset location refers to the location in which your assets are placed. That could be tax-free, tax-deferred, and taxable. Asset allocation refers to where you place your assets. So that could be in different stocks and mutual funds, ETFs, gold, REITs, things like this. I'm going to read off the most efficient versus the least efficient for taxable and non-taxable assets. So the most efficient here, we're looking at the bogleheads.org website, and we're looking at our assets. So the most efficient is low yield money markets, cash, short-term bond funds, tax managed funds, large cap and total stock market index funds, balanced index funds, small cap or mid cap index funds, and value index funds. Okay. Moderately inefficient are moderate yield money market bond funds, total market bond funds, and active stock funds. Very inefficient are real estate and REIT funds, high turnover active funds, and high yield corporate bonds. So these are where you want to place those in a more tax efficient, tax deferred asset location. Three common types of investment accounts. One is a taxable account called a brokerage account. This is your normal taxed account to where you get money from your employer or your business, and then you are already paid tax on that money, and then you have that money free and able to be deployed in any type of asset that you want. So that investments in these accounts are subject to capital gains tax and dividend taxes. They are better for tax efficient investments like index funds, which are low turnover and few capital gains, individual stocks with long-term capital growth, municipal bonds, tax-free interest income, ETFs, which are more tax efficient than mutual funds. Tax deferred accounts, number 2, is more like traditional 401ks and traditional IRAs, individual retirement accounts. Contributions are pre-tax and taxes are paid on withdrawals. Best for investments that generate ordinary income, such as bonds, interest income that is taxed as ordinary income, actively managed mutual funds. Frequent trading generates taxable gains. REITs, real estate investment trusts with high taxable dividends. 3. Tax-free accounts like Roth IRA and Roth 401k. Contributions are after tax, but withdrawals are tax-free. Best for high-growth assets that will appreciate significantly over time. Stocks expected to grow substantially. High-yield dividend bonds, since Roth withdrawals are tax-free, and REITs to avoid taxes on high dividend payouts. Additional considerations. Tax loss harvesting can be done in taxable accounts. You can sell investments at a loss to offset capital gains. For the withdrawal strategy, consider how to withdraw from each account in your retirement to minimize taxes. Required minimum distributions of RMDs for traditional 401ks and IRAs require withdrawals after age of 73, which would increase your taxable income. On the screen now, I'm showing a portfolio which I use. This is my portfolio, not please don't invest in these just because I am. Do your own due diligence and pick your own investments. But this is just me giving out information. This is for information purposes only. All right, first is VTI, Vanguard Total Stock Market Index. It's a broad-based U.S. stock market made up over 3,500 stocks, so it's very well diversified within that one ETF. It is tax efficient due to low turnover and qualified dividends. It is in a taxable account. You can benefit from long-term capital gains tax treatment. In a Roth IRA, tax-free growth enhances your long-term gains. VGLT, Vanguard Long-Term Treasury ETF. This is a long-term government bond. Best location is probably in your traditional 401k or your traditional IRA. Why? Because bond interest is taxed as ordinary income, making tax-deferred accounts ideal. Holding it in a traditional IRA or 401k defers capital gains taxes in a taxable account. Holding it in a traditional IRA or 401k defers taxation until withdrawal. So that means that you have paid taxes on it already. Once your employer or however you got paid, you paid taxes on it at that time. GLDM, SPDR, Gold Mini Shares ETF. The best location is in your Roth IRA or a traditional IRA. Gold ETFs are taxed as collectibles at 28%. So be careful with this one. I just found this out, so this is very good information to know. I just made a trade to sell some gold recently. Gold is at a high right now, so I just sold some of it, and I just found out that I actually have to pay 28% tax on this collectible item. So I will find a way to defer that and not have to pay taxes on it. So it's up to 28%. It's not automatically 28%. A Roth IRA is best for you to place gold in to avoid capital gains entirely. A traditional IRA can also work to defer taxes. VIOV, Vanguard S&P Small Cap ETF. Best location is in a taxable or Roth IRA. Small cap value stocks have high growth potential, making a Roth ideal. In the taxable account, capital gains taxes apply, but are lower than ordinary income taxes. Avoid placing in a traditional IRA due to high future tax rates on withdrawals. VNQ, Vanguard Real Estate Investment Trust, ETF. Best locations, Roth IRA or a traditional IRA. Why? REITs pay non-qualified dividends taxed as ordinary income in your taxable account. A Roth IRA is ideal since dividends are tax-free. A traditional IRA is also good, deferring taxes and until withdrawals. Summary of the best locations. VTI, best location, taxable or Roth IRA. VGLT, traditional IRA or 401k. GLDM, a Roth IRA or traditional IRA. VIOV, taxable or Roth IRA. VNQ, Roth IRA or traditional IRA. I want to walk through a couple scenarios here. One is investing $100,000 in VNQ, so it's a Vanguard Real Estate Investment Trust. So let's say we invest in VNQ for 10 years. And it would yield a return based on historical performance over the 10 years, and it would be 4.86%. So your $100,000 investment in V&Q would grow to approximately $160,000 in 10 years, okay? Assuming the average annual return remains consistent. To estimate the taxes you pay on $100,000 investment with V&Q over 10 years, you need to consider long-term capital gains tax rates. And long-term capital gains are taxed at lower rates than ordinary income and apply to assets held in the asset for more than 1 year. Assuming you fall within a 15% tax bracket for long-term capital gains, here's how you would calculate that tax. Initial investment, $100,000. Future value after 10 years, $160,000. Capital gains, $60,000 and 100. Tax rate, 15%. Tax owed, $60,000, 100 times 0.15 equals $9,015. So you would owe approximately $9,015 in capital gains tax if your investment was in a taxable asset and you fall inside the 15% tax bracket. If you were in a low tax bracket that year because maybe you retired that year, or you had zero W-2 income or very low W-2 income, you would essentially pay 0% capital gains tax on that. If you were single, I believe it's up to like $48,000, and if you're married as a couple filing jointly, it's $96,000. Let's go again with another one. Investing $100,000 in SPDR Gold Shares Trust, GLDM, for 10 years, okay? Based on historical performance over the past 5 years, GLDM has an average annual return of 12.93%. Using this average annual return, we can estimate the future value of the investment. So your $100,000 investment in GLDM would grow to approximately $337,000 in 10 years, assuming the average return remains consistent. Investing in GLDM can be done through various accounts, each with its own advantages and disadvantages. So, GLDM does not qualify for the 0% tax bracket. Gold is considered a collectible and can be taxed up to 28%. So GLDM does not qualify for the 0% tax rate. It will hit a max of 28%, even if your income is low. Other investments, regular long-term capital gains from stocks, mutual funds, etc., can be 0% if your taxable income is low enough. To continue on with GLDM, it is taxed at a max of 28%, and collectibles do not qualify for the 0% capital gains rate. Instead, it will be at your ordinary tax rate. So if it's below 28%, you will pay that. You will pay the ordinary income tax rate on GLDM profits, which for me is 12%. If you want to avoid capital gains, you could 1. Invest in stocks or ETFs instead of GLDM, and stay under the 0% capital gains tax of $94,300 for married jointly filing in 2025. 2. Hold investments in a Roth IRA where qualified withdrawals are tax-free. 3. Use tax loss harvesting to offset gains and losses. I hope you've enjoyed this video. Hopefully it has gave you a little more insight on tax allocation versus tax location. I was concentrating more on tax location on this video, and I hope the information in this video has helped you in determining which areas to put your assets in. Thank you.